I'm Matt Bishar with REIT.com here in NAREIT's Washington, D.C. headquarters. Joining me today is Greg Spick, Portfolio Manager of Real Assets with UPS Group Trust. Greg, thank you so much for joining us today.
Well, thank you for having me.
Now, can you start by telling us about UPS Group Trust, your real estate exposure, as well as your role there?
Certainly. UPS Investments is an internal team of 15 people that manages the pension assets on behalf of UPS employees. Overall, our portfolio is just a little less than $30 billion, and real assets accounts for about $2 billion of that exposure. My role within the group is generally to work on real asset investments, and that can be not only in my own portfolio, but as they fall into other areas, for instance, fixed income, hedge funds, etc.
Now, I'd like to talk about the CEM benchmarking study that was looking at pension fund assets. What did you find most relevant about that research as it relates to key issues being discussed by pension fund managers?
For me, it was really a timely study. There's a lot of discussion and always a lot of questions within the industry around what is REIT exposure and whether I want to build out, what am I really getting when I buy into the listed market versus what I'm getting when I come into the private market. We have a little bit of a different view. I believe that whether I'm coming at from a listed exposure or from a private exposure, we're all starting in the same place. And so when you take that into account, that's one thing that the study, I think, really did a great job of exploring, was the similarities and the correlations between both not only private and public real estate when you account for the time lag.
How did the CEM study results regarding the performance of various real assets compare with your own experiences?
When I look at how the UPS portfolio has performed over a long time, we began investing in the mid-90s into real estate. Our results are very similar to what the CEM studies show. We've shown that over the long time, listed exposures have outperformed by somewhere in the neighborhood of 300 basis points over our private strategies.
Now, you mentioned listed real estate has about a 300 basis point advantage. How big a difference is that really when you look at it over time?
It's quite meaningful. The performance and the exposure over a long term has equated to millions of dollars.
How exactly have fees shaped the asset decisions you've made in your portfolio? And have you gotten better returns with those assets with higher fees?
When I really dig into the fee structures of the various investment vehicles available, REITs have been by far and away very efficient for us. Generally, you're looking at a fee based on NAV, whereas in the private markets, you're looking at fees based on committed capital. When you go back to the great financial crisis in 2009 and 2010, the fee difference is quite meaningful. And the reason being is because we were investing into a falling market. So had we committed capital to a private strategy, we were paying a fee on committed capital. A lot of times when the values were dropping, the fees on committed capital become a very large percentage of the assets that are actually in the ground. During that period, our fee load on NAV in the ground in those strategies was somewhere in the neighborhood of 500-600 basis points on the private equity real estate strategies. Whereas in our REIT strategies, our fee load was well less than that and NAV based. So when we saw a correction happen in the beginning of, or the end of 2010 or early 2011, we saw REIT strategies greatly outperform, not only because the money was in the ground and had the ability to really capture the upside in the markets, but it also had a fee difference of somewhere in the neighborhood of 500-600 basis points.
And how does your strategy combine various private real estate assets with those of listed REITs? And what are the overall allocations, and what are you trying to achieve in that combination?
We mix private and public exposures. Before we make a private investment, I like to look and see what I can build out in the listed markets. Generally, I can do that on a more cost-efficient basis, and I can keep liquidity. I think that often when you're looking at billing out exposures, for instance, let's say I'm going to look at a CBD office billing. I should go look and see, how Boston property stock is trading and what the intrinsic value is there. Or if I'm looking at an apartment billing, I should look and see what I can build exposure to Avalon Bay or one of the other apartment REITs. So for us, I want to understand the listed markets are a benchmark from which to begin to make investments and allocations into the private markets. But before we do that, we want to make sure that we're accounting for the fee differentials between the various strategies and really working in, how the net of fee performance we would expect across the two.
And finally, did the CEM study results give you any reason to go back and look at your portfolio allocation strategy?
Not really. For us, we've generally been approaching it for over the past few years in this manner, and really the results just really confirm that our approach has been the correct one. I don't think that we're ever going to pull out of doing private real estate completely, but really what we do is we use private real estate to complement our exposures. If we just want real estate exposure and real estate beta, then we can build that very effectively through the listed markets. I'm using the private markets, though, to really complement the exposures I'm getting in the listed market. I certainly do not want to be in a position where I'm locking up capital just for the sake of locking up capital and getting the broader exposure.
Greg, thank you so much for joining us.
Well, thank you for having me.
For more on this and other real estate news and analysis, be sure to visit REIT.com.